Hello everyone, and welcome to the very first Marine Money webinar. Hopefully the technology is working seamlessly and you can all hear me. I'm your host, John Chair, and I handle the content and membership side of the business for Marine Money. We are launching this webinar series to help connect and engage the ship finance community around key issues it's facing and how to navigate them now and in the future, especially during this time of COVID-19. Today, we are going to pick up on a hot topic before COVID-19 took over the world and discuss how ESG will be affected during this time and after it. This is obviously a topic of interest still, as we have over 100 people registered for this event. Here to take us through this topic is Joachim Nahem, who is the founding partner of the Governance Group, an advisory firm that focuses on sustainability performance and which recently published a report titled ESG in the Ocean Industries. Now, before I hand over the controls, a quick note to our audience. You will be on mute for this presentation, but feel free to comment and ask questions in the chat box. If we have any time at the end of the presentation, we will see if we can do a little Q&A. Otherwise, we will follow up with you individually after the webinar. Thanks again, and without further ado, I will hand over the controls.
Yeah. All right. Hello, everyone. Good to be with you this morning, afternoon, or evening, depending on where you are. I'm in Oslo in Norway, and like many other people around the world, we are in lockdown, or at least semi-lockdown mode here, hence the webinar. I hope everyone can see the presentation up on their screens and that you can hear me well. If not, perhaps send a message to John and we can try to sort out any technical issues that may arise. Good. So I'm going to take you through this presentation on ESG, that is environmental, social, and governance factors, and of course how the current corona or COVID-19 situation affects ESG and vice versa. Before we go into the full details here, obviously we're living in very difficult and challenging times, but perhaps just as a little bit of relief, comic relief, before we get too serious about issues. I think we're going to see a lot more of this as we work from home and try to make the best of the situation. Good. Since I can't hear any reactions, I'll assume that we all thought that was somewhat. And on to the actual presentation. So take you through. I'm going to out over the next 20 so. So let me get started with, of course, what is on everyone's mind and agenda these days, COVID-19, the situation. The environmental aspects here on COVID-19. One of them is obviously with plummeting oil and gas prices, whether the renewable transition is likely to take place as we thought before the corona outbreak. That is, with lower prices, incentives there to transition fuel that is used, even though shipping, when it comes to renewable, had not really started on that transition, in that renewable fuel and especially electric possibilities are quite limited. Now, when it comes to the S in ESG, social assets, a lot to how you protect assets and people, emergency preparedness, how you take responsibility for employees' health, and these are king, and it obviously relates to stakeholder engagement. And as I will speak about shortly, this is really one of the big differences on ESG, the way it is today, and what corporate social responsibility engagement, meeting experts, not just shareholders. And this is really key, I think, during this period, how companies interact with stakeholders of dealing with the crisis. The governance aspect here is also very interesting when it comes to the COVID situation, because it is also about the board, company management. We are seeing now that companies are talking about not paying out dividends with this financial situation and with possible bailouts from governments as to what the company does, how you weigh interests and expectations from stakeholders, and also about management response to the situation in terms of protecting assets and people. How prepared were companies? How well did emergency plans work? How good was the governance of the company to deal with this situation? Then we're also seeing issues that, to be honest, not seen or were very hard to actual outbreak or pandemic, and that is without cybersecurity. We're also seeing an increase in cybersecurity breaches. Systems are obviously weaker with people being scattered at different locations and not working within the firewalls, if you like, of offices. Then lastly, what I would mention here is the reputational risk of not doing anything or not doing enough. After the most severe phase of the COVID situation, there's likely to be an assessment of how companies, how different organizations dealt with this situation. And I think there is a risk for those that appeared not to have expectations when this is going to be assessed. So there obviously are reputational risks, but also opportunities for companies who get this right. Now, the big question, which we don't know that much about, is how companies that are screened or that do well on ESG are performing in the stock market. Before the COVID-19 crisis, changes, if you like, that there is increase when it comes to funds and individual stock performance. Again, I would maybe not read too much into this. The correlation here may be spurious, but there is some indication that so-called ESG funds are declining or seeing less value being lost than others on the stock in terms of financial performance. We'll just have to wait and see how that goes. So let's jump into ESG, as in what do we actually mean by environmental, social, and governance factors. One big challenge has been that with all the differences between companies, industries, and geographies, how do you find a common set of ESG factors that you can consider across the board? This is one of the big challenges also on ESG, to make sure that we're not comparing apples and oranges, but that we have some way of seeing across industries and companies. What we have outlined here are what we think are key E, S, and G factors that apply pretty much to any business and any be used especially by investors when they're looking at opportunities, making investment decisions, and also when they are what they're looking for in terms of performance metrics from companies. Now, one is that ESG or sustainability and some of the issues that were mentioned in the previous slide have gone from being kind of fringe issues, that is, civil society or activists being very concerned about the environment, human rights, or CEO pay for that matter, to really finding its way into the heart of capitalism. So we have many ways taken a trip from Greenpeace to this man here, which you see on the right side, Larry Fink, the CEO of BlackRock, which is the world's largest asset manager. I'm not sure the exact value today, but about 2 or 3 weeks ago when this presentation was originally put together, that's $1 trillion under management at BlackRock. They have, or Larry Fink, one should say, ESG and sustainability. He has said that each company's prospect for growth is inextricably linked inextricably from its ability to operate sustainably and serve its full set of stakeholders. And this idea of stakeholders, again, is that you're not just maximizing profit for shareholders, but there's this sense of maximizing value for stakeholders as well. And this changes very much the parameters on investment and ESG, because it also means that you need to take this into consideration of how to be an attractive or a valuable company to investors, not just then activists or Greenpeace. So one of the key things here also is that Larry Fink speaks about climate change as a fundamental, that it's going to fundamentally reshape finance, that is climate risk, the value of assets and companies in 10, 20, and 30 years, or how this plays out after the immediate crisis. Now, if you say if you follow the money, if you like, it's not just words. We're seeing that there's a large increase in funds, ESG filter on, if you like. What you see here is an overview of sustainability investments using different approaches. The largest one is a negative screening, that is, managers are not allowed to invest in companies or in assets that have some negative ESG connotation. That is, or that has a predefined negative value, that it is excluded from their investment universe, if that is tobacco, alcohol. In some cases now we're also seeing oil and gas increasingly being a factor that excludes investments. And then you can go into more detailed ESG investment approaches that look at companies need to have ESG integration. Some of them are about positive screening, where they're looking for specific companies that, for example, in renewable sector, or that contribute to the UN Sustainable Development Goals, etc. So in sum, what we're seeing here is a major amount of money under management, which is screened in some shape or form using ESG parameters. The numbers for 2018, and I think this is on this slide, we're talking about $30 trillion US. The numbers are not official now, but we've been doing some research and we found that as of 2019, this number has grown to $40 trillion, which is under management of large and small asset managers that is screened on ESG. So this is a big deal, in that shipping, like all other industries, needs to access global funds, and these global funds are increasingly conditioned on ESG. Now, one key aspect for you on ESG is this idea of materiality. As there is a lot of talk about ESG, there's been a tendency to kind of jump on the bandwagon and say that we have a policy or approach on every possible ESG topic. Good practice, and this is really one of our key pieces of advice to you, is that you need to focus on what is material to your company. Focus on what is material to the shipping industry, focus on what is material to your particular company within the shipping industry, because there will be different ESG factors which are important here. And if you do this, you are also more likely to do well over time and be taken as a serious actor on ESG. And the guidance from the stock exchanges for those companies that are listed, if you look to the US or NASDAQ or the Oslo Stock Exchange, which also has a fair amount of listed shipping companies, it very much advises you to focus on what is material. Other things may be important, but they're not material to your company. So that's really one of the key pieces of advice we have to you. And I will come back to this idea of materiality when we speak about the SASB framework. Now, there are many standards or frameworks out there on ESG. Some of them you may have heard of, some of them may be new. These are increasingly used by investors and also other stakeholders to evaluate companies and also investors in terms of how well they follow ESG norms and parameters. Some of these are ratings in the same way that you have credit rating agencies that say something about a company's credit worthiness. You're looking at MSCI, Sustainalytics, and even Bloomberg and others have ESG ratings now that take mainly listed companies and rate them in terms of how well they perform on E, S, and G. This is increasingly then used by investors for investment decisions, but at the same time, there is a big challenge here with these ratings in that they are not unified in their metrics or in the way they define ESG. So you could possibly end up with a good rating on through one company or through Bloomberg, for example, and then a poor rating through MSCI. So this has also caused some frustration in the marketplace in that these rating agencies are not really, the ESG does not always lend itself well to coming up with quantitative assessments in the same way that you have for financial aspects or for credit. Now, the big game changer here is the taxonomy, the EU taxonomy, which is going to try to set a common language for the financial system, not just in the EU, but you could say globally, because this is going to have repercussions way beyond the EU zone, if you like. And this really goes to the heart of the main challenge with ESG, in that there is no universal definition of what we mean by emissions, labor standards, or when it comes to governance. Again, this has been regulated to a certain degree by national authorities, or it's just been normative or a nice to have type of thing. The EU now is looking or doing a very systematic approach to sustainable finance, where the idea is to define what are sustainable green financial products and how the different market actors may use these definitions. And it will also set requirements for companies when it comes to disclosures on how you report on climate risk, how you report on labor conditions, etc. So this is going to have a big effect on the market and different actors when the taxonomy is out. It's currently at a more technical stage where there are reports being delivered, but in 2021, it is expected to be adopted by the Commission, and it will come into effect, if you like, for companies in 2022. That is, when reporting on 2021, you would likely have to disclose information in accordance with the taxonomy. We can skip this, but just to say that again, the EU is also going to be a significant player in terms of potential CO2 pricing. There is discussions whether the shipping sector will be part of this approach. But again, these are things to watch if you're in the shipping industry. Now let me shift to opportunities, because on finance here, so far we've been speaking about challenges with defining, about risks, regulation to come, disclosures. But the upside to all of this money being conditioned on ESG is that those who can position themselves can also tap into new finance or new funds, green finance, if you like. With the $40 trillion that are earmarked for ESG investment, there are also many opportunities, not just for assets, listed assets, but also for loans and debt that are to have green criteria. So one of the things we are seeing an increased interest in are green bonds or green debt in general, green loans being listed in different markets. And we've even seen in this example here, a company that is associated more, if you like, with oil and gas or dirty energy, having received a green bond here, or being able to issue a green bond based on a green project. I don't have time to go into details on exactly how this works, but the idea is that you can go to market and say, we have a green project which is in accordance with bond guidance and second opinion, and you can help finance this. And there is a lot of money out there that is desperately looking for green projects, if you like, with relatively low expectations on return. Now, the same we can see on other types of lending instruments. Maersk here, and this was about, I guess, a month ago, was successful in placing what is called a sustainability-linked loan, or credit facility, excuse me, which essentially gives it a discounted loan if it meets milestones or KPIs, key performance indicators, in this case related to emissions. By lowering emissions, the market is going to reward it by taking off lowering the interest rate on the loan it has. So again, there's a lot of nudging and incentives in the financial markets to be able to set up measurable achievements on ESG and then having the market reward you through different instruments. And this, of course, is very significant to the shipping industry, which is associated with emissions. Now, if we go into the last part here, which is about reporting or disclosures, which is very important for ESG to work in the marketplace, because it is about investors or banks, as we saw, having information on performance. You could not have a sustainability linked loan or a green bond or any of these opportunities unless companies were able to report in a predefined manner or disclosures that the market has defined. So if we just look again at what is imperative for the market or for the industry, the shipping industry here, as well as common targets and collaboration, transparency in terms of disclosures from the companies. This is something that is not always required, but is expected, and something we think is going to be regulated with the new EU taxonomy. Now, what is important again is that companies disclose material and financial parameters, that the data is somewhat comparable, especially on emissions, but also on social aspects, if you like, relating to health, environment, and safety, on injury and loss rate numbers, ESG management and governance structures, etc. So this is really about what is expected from the industry and then from companies. Now, if we look at the specific framework that is out there, and you've seen these other examples of how this is a little bit unregulated or a jungle and messy, we think what is called SASB, that is the Sustainability Accounting Standards Board. It's a US initiative, but it again applies universally, if you like, is the best standard when it comes to shipping and perhaps when it comes to disclosures in general, because they have predefined materiality. That is, they have said, based on interactions with industry and markets, these are the key issues for your industry. So they have, in this case, defined 77 industry-specific issues for marine transportation, or shipping, if you like. And these are the ones that we use when we assist companies in terms of disclosures. And if we look here, these are kind of the headings, if you like, overall on the disclosures: greenhouse gas emissions, air quality, ecological impact, employee health and safety, business ethics, accident and safety management. So under each of these headings, you will find specific disclosures, which are usually quantitative, in that you have to be able to come up with a number, and then that would go into your reporting, your annual reporting or sustainability reporting, but that it is publicly available. Now, here is an example from Frontline, a company that we have assisted with doing ESG reporting in line with the SASB standard. You can look at the slide here, and also I have a link at the end here which will take you to the report, so you can have a look specifically on how they have structured their ESG reporting using this SASB framework. And we have assisted about altogether 20 shipping companies, listed shipping companies, using this framework, and the feedback also from financial actors, investors, and also banks in the shipping industry is that this is good practice to disclose using this framework. Here are also some examples of other companies that we've assisted using this framework or other sustainability reporting. Here are some publications which may be of interest. John mentioned one of these during the introduction, and I can share with you some links here. I'm going to end there because I think we've used up our time. But if I was just going to summarize in 2 words when it comes to, firstly, COVID-19 and ESG, the bottom line is, of course, we don't know exactly what this situation will look like during and after the crisis, but that ESG is a trend and not a fad. We are convinced, and that ESG will still be relevant afterwards. And this may actually offer both some risks, of course, but also opportunities in terms of how companies perform and deal with the COVID-19 crisis. And the second point is that expectations, whether regulated or not, have increased on ESG. So not paying attention to this is going to be a risk. And this doesn't really matter whether you work for a shipping actor with a fleet of 1 ship or 50 vessels. These are expectations across the board to companies and the industry. I will end there, John. I'm not sure if we have any time for questions and answer, but I'm happy to engage with you here or in a follow-up to this webinar. Thank you very much.
Thank you so much, Joachim, and apologies to everybody on this webinar for the choppy start. Hopefully those issues resolve themselves as we went along the presentation. We will definitely make this presentation and the recording available afterwards, and we'll do that on marinemoney.com, and we'll also send you an email afterwards to follow up to make sure that you have all the resources that you need for tuning in. We have time maybe for one question. I know that we're over, but one question that came in, Joachim, was many ship owners are switching to LNG propulsion. Do you think this is considered ESG friendly?
It's a very good question, and we have worked with ship owners, including who both use LNG for propulsion and who transport LNG. My answer would be that 5 years back, LNG was probably seen as something that was greener, but that with the EU taxonomy coming now, LNG is likely not to be classified as sustainable or green. Of course, there are discussions whether this is correct or exactly how this will be dealt with, but I think there are challenges with the taxonomy because it is also going to define across the board what's green and not. And as long as there are technological solutions for certain industries, including shipping, where, as said, electric propulsion is not possible, or at least at a scale that is significant, looking for second best options is always good. But again, just the same with scrubbers, there are sort of pros and cons, and what this looks like in 5 and 10 years time is very hard to say. So I think LNG falls in that category of it's difficult to say, to be honest.
Okay, great. And then I guess just to follow on that answer, is there a standard ESG document that you can recommend or companies should have in their corporate documents?
I think what we are increasingly seeing is that above and beyond disclosures or reporting, some kind of an ESG strategy or policies that pick up on key ESG areas, whether it be energy, labor, health, environment, and safety, that you need to sort of have an ESG toolbox, if you like, as a company. That the SASB framework, which we shared with you, gives you part of this. Otherwise, we're happy. We've also included several sustainability reports in a link here, which speak of the sort of ESG documentation that is expected from a company, from strategy to policy and disclosures. So I would speak more of an ESG toolbox, if you like.
Fantastic. All right, great. Well, thank you so much for that quick Q&A. Once again, everybody on the line, thanks for coming along and tuning in. This is a journey. Next time we do this will be better. We will not have that audio choppy start. So appreciate you guys sticking with us. So thank you very much. And we'll see you all next time. Thanks, Joachim.
Thank you.